What if the investment choice you're making right now is slowly costing you thousands of dollars without you even realizing it? Stocks, ETFs, and mutual funds all claim to help you build wealth. But depending on what you choose, one might quietly outperform the others over time. The truth is, most beginners pick based on hype, not understanding. And that decision can affect your long-term results more than you think. In this video, we will break down how each option works, who they're best for, and which one can actually make you more money. Stick around till the end, because I will share a bonus tip that most investors ignore. It's simple, low effort, and can quietly increase your returns behind the scenes. Welcome to Fintech Innovate AI, where we break down personal finance and investing into simple steps that anyone can follow. 1. The basics. You must understand first. Before we even talk about which one can make you more money, it's important to understand what each of these investments really is. Stocks, ETFs, and mutual funds often get mentioned in the same sentence. But they each work in their own way when it comes to risk, fees, and long-term growth. Let's start with stocks. When you buy a stock, you're buying a small piece of ownership in a company. If the company performs well, your share price goes up and you make money. If it doesn't, your investment can drop fast. Now let's look at ETFs, or exchange-traded funds. ETFs are like a bundle of different investments, often made up of stocks, bonds, or other assets. They offer instant diversification, lower risk than individual stocks, and usually come with low fees. Then we have mutual funds. These are also baskets of investments, but they're actively managed by professionals. You're paying someone to pick and manage the investments for you, which usually means higher fees. So even though all three can help you grow money over time, they come with very different strategies, levels of control, and costs. And here's the good news. You don't need to be a financial expert to understand them. You just need a clear comparison and the right mindset to know which one fits your goals best. 2. How each one works in real life. Let's look at how stocks, ETFs, and mutual funds actually work in a real-world investment portfolio. Each one has a different level of risk, control, and potential reward, and it's important to know which suits your goals. Stocks represent ownership in a single company. When you buy one, you're betting on the success of that company alone. If it grows, your returns can be high, but if it fails, you could lose a lot. That's why investing in individual stocks carries the highest risk and the most volatility. ETFs, or exchange-traded funds, offer a middle ground. They hold a basket of different assets, like a mix of stocks or bonds, and trade on stock exchanges like regular shares. This means you get more diversification, less risk, and more flexibility to buy or sell anytime. ETFs are ideal for passive investing, especially for beginners who want to spread their money across multiple companies without picking each one. Mutual funds are also diversified, but they work a bit differently. They're managed by professionals who actively select where the money goes. While that sounds appealing, mutual funds usually come with higher management fees and less control for the investor. You can't trade them during the day like ETFs, and those fees can eat into your long-term returns. So when comparing stocks versus ETFs versus mutual funds, think of it this way. Stocks give you control and big potential, but also high risk. ETFs give you balance, easy diversification, low fees, and flexibility. Mutual funds offer professional help, but at a cost and with less flexibility. Understanding these differences helps you build a strategy based on your comfort with risk, how hands-on you want to be, and how you want your money to grow over time. 3. Which one can actually make you more money? Now let's get to the question everyone wants answered. Which of these investment options will actually grow your money the most over time? The truth is, it depends on your personal strategy, how much risk you're willing to take, and how long you're planning to invest. Let's break it down using real-world logic, not just theory. Stocks have the potential to bring in the highest returns. If you pick the right company early, like Apple, Amazon, or Tesla, your investment could multiply many times over. But with that potential comes high risk. One bad earnings report, and your stock could drop overnight. It's a high-risk, high-reward game that requires attention and strong emotional control. ETFs, especially index funds, offer more stable and consistent long-term returns. They track the market, not chase it. You won't see sudden surges like in single stocks, but you also avoid big crashes tied to one company. Many ETFs have historically returned 7% to 10% per year on average when held for the long term. That's powerful growth when you stay consistent. Mutual funds can perform well, but fees often reduce your gains. Actively managed mutual funds may beat the market in some years, but over long periods, most don't. And when you factor in management fees and sales charges, your total return usually lags behind similar ETFs. Let's walk through a quick example. Imagine you invest $10,000 today. If that money goes into a strong stock, it might grow to $40,000 in 10 years, or drop to $5,000 if things go wrong. Put the same amount into an index ETF growing steadily at 8% annually, and you could end up with around $21,500 after a decade. That's without the stress, the guesswork, or the roller coaster. So which investment is most profitable? If you're skilled and lucky, individual stocks can win. If you want peace of mind and consistent growth, ETFs, especially index funds, are often the smartest way to grow money over time. Section 4. The hidden costs. Most people focus only on how much they could earn. But smart investors also pay close attention to how much they might lose, quietly, in the background. It's not just about returns. It's about what you actually get to keep, and that's where hidden investment costs come in. Let's start with management fees. Mutual funds usually charge you a percentage every year, even if the fund performs poorly. These fees might seem small, but over time, they can reduce your gains by thousands. ETFs, on the other hand, are known for being low cost. Most ETFs follow indexes and don't require active managers, so the expense ratios stay low. That means more of your returns stay in your pocket, not someone else's. Stocks don't have any fund fees, but they come with their own hidden costs. If you're trading frequently, you could face high commissions or taxes on gains. And if you panic sell during a dip, you might lock in losses that hurt your long-term returns. Many investors forget to account for these costs when choosing an investment. But over years or decades, they quietly drain your potential wealth. So before you decide where to invest, ask yourself, how much of my return will I actually keep? Because sometimes the safe or popular choice ends up costing you more than you think. 5. Which one fits you best, based on goals and lifestyle? When it comes to investing, there's no one-size-fits-all answer. The right choice depends on your personality, your goals, and how involved you want to be. If you enjoy reading about businesses, analyzing market trends, and staying up to date with financial news, individual stocks could be a great fit. They give you full control and the potential for high returns, but they also come with higher risk and require time and research. If you prefer something hands-off and simple, ETFs are usually the best option. They offer built-in diversification, lower fees, and are ideal for long-term passive investing. You can set it and forget it, knowing your money is spread across many assets. For those who want professional help and don't mind paying for it, mutual funds may be worth considering. A fund manager does the work for you, choosing investments and managing risk. Just be aware of the higher fees and the fact that you won't have full control over what's in the fund. The key is to match your investment style to your daily life and your comfort with risk. Ask yourself, do I want full control or peace of mind? Do I want to manage it myself or let someone else handle it? And the best part? You don't have to pick just one. Many smart investors combine all three. Bonus tip: the overlooked strategy that quietly builds wealth. Most people chase the next big investment, hoping to time the market or catch a trend. But the smartest investors rely on something far less exciting, yet far more powerful. It's called automatic investing. This strategy works no matter what you invest in: stocks, ETFs, or mutual funds. By setting up a fixed amount to invest each month, you build wealth consistently without second-guessing every market move. It's called dollar cost averaging. You buy more when prices are low and less when prices are high, which helps smooth out your cost over time. Even better, automation removes emotion from the equation. You are no longer reacting to fear, hype, or market noise. Your plan just runs in the background. Over time, this habit compounds into serious results. You're building wealth without stress, without timing the market, and without needing to constantly watch your portfolio. So if you want to grow your money with less effort and more consistency, start with this one habit. Set it and forget it, and let your future self thank you for it. If this video helped you, make sure to like, subscribe, and share it with someone who needs it. Thanks for watching.